Good morning, everyone. Thank you for joining us today for how your books translate to your tax return and how to improve both. Very important topic today. My name is Paula McCain. I'm one of the senior business advisors with the North Central Texas Small Business Development Center. Today is International Cabernet Day, so go enjoy a glass of wine later on after the webinar. SBDC is a leading provider for assistance for small businesses. We are grant funded, and because of that, we can bring our services to you at no cost. Again, today is how your books translate to your tax return and how to improve both. Quick reminder, we'll be recording this webinar, then adding it to our YouTube channel. Today's webinar will be interactive, so please feel free to raise your hand or unmute yourself if you have a question or comment. Our presenter today is Bryce Forney. Bryce is a Bay Area sole prop CPA preparing tax returns mostly for business owners who use cloud books for their business. He's an understandable, likable, mobile accountant working in hotel lobbies, libraries, and liquid spaces. Welcome, Bryce.
Thank you. You want me to go ahead and
Go ahead, take it over.
okay, super. Okay. So I'm really glad to be here, and I want this to be of value to you, whether you prepare your own tax return or whether you have a professional preparing your tax return. I feel like everyone should know what's involved. So I feel like this is going to be like therapy for me as a professional accountant because we don't really talk about this a whole lot, even when we're talking tax preparer to business owner client. So hopefully this will give you some insight so that you can better work with your books and your tax return, or so that you can better understand and better feed information to your tax preparer. So as always, I want to highlight the SBDC that has many resources for you as a small business owner. And that's one of the most important things in business, is to use the resources that are available to you. Of course, I'm partial to the North Central Texas SBDC, but your local SBDC is there for you to grow and prosper as a business. So just a quick background about me. I'm a CPA, I'm a professional tax preparer. This is what I do for a living. And I am a QuickBooks Pro Advisor, which means I've aligned with Intuit, taken an exam so that I can be listed on Intuit's site when business owners like you are looking for either a tax preparer or someone to work with their books. So I'm really active in the books. Some tax preparers really have nothing, they want nothing to do with the books. They consider tax preparation a completely independent arm, and they want to get information however you send it. They really don't want to deal with the books. So I prefer to actually go into the books. If I have questions, I'll use the books directly. So that's sort of how I sit within the tax preparer market. So I wanted to also define what we mean when we say the books, because we tax preparers are often referring to, well, just send me your books, or where are your books, or how's the status of your books? So I wanted to just make it clear, because oftentimes we professionals, really of any genre, get a little too comfortable with lingo. So when we're talking about the books, we're talking about whatever system you use to house all of your transactions, just money in from customers and money out to vendors. That's most of what happens for a business. So whatever system you use to track that is your books. So in a very simple scenario, It might be a cash register at a retail register would produce what's called a Z out, and that would tell you here's the total revenue, here's the total sales tax that was collected, so that you know what the total money in was, and it'll also break it down by how much was received cash versus check versus credit card. Again, at least back in the day, my father had a hardware store when I was growing up, which was a great learning for me about how small business works, as well as cash register mechanics. So those, and then most small business owners are using books that are formal software. Either in the United States, that most often translates to QuickBooks Desktop or QuickBooks Online. Although there are other players in the books software market. So there's Xero, Xero, there's Accounting Suite. It's kind of a mouthful, but it's a great app. And Stacy Kildall mentioned last week Checkbook. So there are different options for how to how to create your books. And some of those apps, by the way, will just do one sole function. So, so there may be an app that's solely dedicated to tracking revenue. And that's the cash register example. All that's tracking is money in. And then that individual, the business owner, would use a separate app or separate method to track expenses. And it could be as simple as the check register. That's back in the day, that's how expenses were tracked. You had basically a log, and then you can transfer that to an official accounting system. In the manual days, that would have been a ledger. But I don't want to create fear with you. Just understand that we're talking about some mechanism to track money in and money out. At a very basic level, that system for recording money in and money out, that could be the bank statement itself. If all of the revenue for the day is deposited, or day or week or month, is deposited into the bank account, and all of the expenses are paid by check or debit card, then the bank statement really is a complete set of, it's showing all the credits, all the revenue, money in from customers, and it's showing all the debits, the expenses, the money out to vendors. So that's the idea of what we're referring to when we say books. And if you're using, I'm just going to use QuickBooks Online as the example. That's pretty common. If you go back 20 years, the most prevalent accounting software in the United States was QuickBooks Desktop. So if somebody was using a system, a computer system, as we called it at the time, for handling their books, it was almost always QuickBooks Desktop. And QuickBooks Desktop unseated an app called Peachtree at the time, which, like its predecessors, was sold in modules. And QuickBooks Desktop was the first app to come out and say, you can have everything: accounts receivable, accounts payable, inventory, all the money in, money out. You can have it all for one low price. So I feel like QuickBooks Desktop is the best thing to have happened to double entry accounting since it was invented. Yeah, I said that, about 450 years ago. So it was monumental at the time, because now you've got a really inexpensive way to track all of your activity. While it is still the case that QuickBooks is the prevalent player in the United States as far as accounting application, and QuickBooks Online is becoming more and more prevalent as opposed to QuickBooks Desktop, the price has changed. So now it's more expensive to play in the software market, but it's also really valuable for you as a small business owner to have a tool that basically automatically tracks your revenue and your expenses. And it has tools such as creating forms like a sales receipt an invoice for money in, an expense, a check, or a bill for money out. So that's the idea behind the books. And at a very simple level, having your total revenue less your total expenses is how you get to net income. And net income is what we use in the United States as a basis for income tax on business earnings. And if you've been in business for a while, you know that there's also self-employment tax that applies to earnings. So there's no shortage of tax in the United States. So what we're looking at here, I wanted you to see a common report that is valuable to tax preparers and can also be valuable to you as a business owner in analyzing how profitable your business is and where your money's coming from and where your money's going. So that's what the profit and loss report is all about. We call it a P&L in the biz. I'm frustrated by the fact that this report name of profit and loss or P&L has become such a common thing. It's called an income statement. There's no financial statement from any business that has to prepare actual, real financials that would call this a profit and loss. But it's become common because that's what QuickBooks calls it. I also find it frustrating semantically that we're calling it profit and loss. It's profit or loss, really. So, but other than those details, you can see here what's circled is total income. So that's total money in. Money in some may be from customers, some may be rebates on a credit card, and some may be interest and dividends, things that are not really related to the operation of the business, but they're related to how much money is in the bank. You may have, as a business, you may have other sources of earnings outside of your regular operations. And that's okay. The total is going to go into total income no matter what category the income is. But for most businesses, they've got essentially a few categories that are adding up to total income. So on your P&L, that total income means total money in from customers and any other source. Then there's a category called cost of goods sold. And if you're a services business, then that term becomes cost of sales. But it's the same concept. It's easy to understand from a retail standpoint or a wholesaler, anyone who's selling products. Cost of goods sold is the direct cost that the business has paid for the inventory that it sells or the products that it sells. So those are direct costs. And I mentioned that twice because if you're in a service business, you may also have direct costs. In other words, for each dollar of revenue, you're going to have some component of cost. And I think a good example is a law office. Let's say there are 8 attorneys in this law office, and the lead attorney sells a big project, and one of the other attorneys is working on that project. The amount that the firm is paying the attorney that's working on the project directly would be the cost of sales for that law firm. And the reason it's important to measure the direct cost of producing services or selling goods is because then we arrive at gross profit. And then from gross profit, we can subtract costs that are not related to sales dollars. So to be very specific, in the law firm example, there is a cost for each, normally attorneys sell hours of time. So per hour of revenue for a given attorney, they're paying that attorney wages. So the wages are the direct cost. The more revenue goes up, the more that cost of wages is going to go up. And that is a direct relationship. You can't have more revenue without more of the cost. So that's what direct cost is all about. So I wanted to highlight, and that's why it's called out on the left side, that revenue less your direct costs is your gross margin. So gross margin can also be stated as gross profit. And from that amount is what you subtract all of your costs that do not tie to revenue. So rent is going to be the same no matter how much you sell. The rent is going to be I mean, there are some rental arrangements that are based on gross receipts, or some kick in if you're running a Jamba Juice or something like that. The landlord may attach to revenue if they have confidence in the revenue, or if they kind of control it in the Jamba Juice scenario. But most landlords, when they're renting space, are renting by the square foot. And it doesn't matter what you're selling or what you're doing in that space, you're going to pay the same, $3 a square foot for that space, no matter what. So that cost is what we refer to as an overhead cost. And that's just a fancy word for it's not tied directly to revenue. So, so rent is one, utilities is one. Utilities has more to do with how much energy you're producing, obviously. That may have some relationship to how much revenue you're generating, but it's not direct. The utilities can go up when revenue is going down, for example. So those are the two main categories of cost. You have your direct cost, either called cost of sales in a service business, or cost of goods sold if you are selling products. And then you have overhead expenses. And after those two categories of expenses, you get to net income. And net income, as I mentioned before, is the basis for tax. So that's what we see on the books side of the equation. This is a very simple example. We're looking at a highly abbreviated profit and loss report, but I wanted you to understand that all this report is showing is total money in and total money out. It's categorizing it by how we received the revenue and how we spent the revenue, but the end result is just summarizing all of those transactions that have been recorded so that we can get to how much money the business made. So that's the book side of understanding. I mean, hopefully that has given you a little context behind what we say when we're talking about the books, and what the books kind of where they're headed, what we're getting out of the books. Most often, we're getting that profit and loss report. We're getting what is net income.
Hey, Bryce,
Mm-hmm.
can you go back to that slide,
Absolutely.
please? Okay, how does the total landscaping services relate to the other figures?
Great. So the total landscaping services is just a subcategory within income. So this is a design and landscaping company. So they have some design income, and then they have basically reimbursement with margin for materials. That's the total job materials. So they're saying on landscaping specifically, we're earning 6,500. It's a portion of the total income of 10,200. The other components are the design income, that's the very top category, and then also a very little bit from pest control services and sales of ancillary products. Does that make sense?
Yeah, okay. So you would take the design income, add it to the job materials to
It's
get the total landscaping?
yes.
Okay. And then add those other figures in there, the pest control.
The product income and the services to get to the total.
Okay.
Yeah, it is there. I think there's another parent category that I've
Okay.
cropped out. So you've pointed to a flaw in what I thought I cut out, just
Oh,
the unnecessary stuff. But there should be, you know how it says income at the very top and there's an
yeah.
arrow down? There should be another arrow down that says job materials. Oh no, no, that is there should be another one that says landscaping services, and that would include the design income and the job materials.
Okay.
So
Okay.
it's,
Gotcha.
yeah, I've cut out some of the items in the report. So
That's okay. I was trying to come up with that
yeah,
10,000.
no, but that's another
Yield
good thing to
seems to be
call
the
out.
cost.
This report doesn't self-solve. These numbers do not add up
Okay.
right. I've just cut out categories because I wanted to highlight the totals.
Okay. Gotcha. Sorry about that.
So I'm glad you brought that up because it literally will not add up to total income or net income. I've cut out large parts of this. So
Gotcha. Gotcha. Thank you. Thank you for
yes,
indulging me.
thank you. That's very helpful for everyone to know. I should have mentioned that I've cut this up to simplify. So when we switch gears to the tax return, and I know this is where many small business owners want to just close their eyes and not really think about it. My goal is to simplify the tax return, just like we did with the books and the profit and loss, so that you can understand these components that are reported on the tax return. It it may not be something you want to do, but I feel like it's understandable for any taxpayer to be able to get the general picture of what's going to go on in the tax return. So the tax return is separating income by how it was earned. So for example, the tax return will want to know how much did you earn in wages versus how much did you earn in interest income. And the reason the tax return separates these by category is that there are different taxes that apply. They're going to apply a different rate to the income, or they're going to use that type of income in a separate calculation. So one example is wages are considered earned income. You worked and labored to create that income. So that earned income is going to be used in some tax credit calculation to determine. I mean, I sort of painted myself into a corner here. So you could have the earned income tax credit where the IRS is determining how much credit you get based on wages. You could have $1 million in interest income, and that might have an effect anyway, but you could have, let's say, $50 in interest income and $2,500 in wages. The IRS is going to see that as, oh, this individual has worked, so we're going to make the earned income credit available to this taxpayer. If you flip those numbers around, if it's $2,500 of interest income and $50 of wages, then the IRS is going to view that taxpayer, just for purposes of the earned income tax credit, as a taxpayer who didn't do the activity that generates the credit. It's earning income that has the impact. So that's one example of how these categories of income matter. So there's going to be some other calculation. That's why they're splitting it out. If all income was taxed the same, we would just have one line on the tax return saying total income. But that's not the case. The IRS, and if your state has tax, they can tax different types of income different ways. So we start with total income, and then we subtract what the IRS calls adjustments. And an example of an adjustment is that you're taking off for self-employed health insurance, for example. It's just a category where the IRS is giving kind of special consideration before we get to a figure called adjusted gross income. And you may have heard of adjusted gross income or AGI. This is used in a lot of statistics that are based on how much Americans are earning. So, for example, I've never been delighted that adjusted gross income is kind of the basis for statistics. And here's a reason why. I feel like total income is the best measure of earnings because if a taxpayer is putting a lot of money into a 401k or into a SEP IRA as a self-employed individual or into a traditional IRA, although the limits are relatively low there, if a taxpayer is putting a lot of money into retirement, that reduces adjusted gross income. And in my view, that understates how much income that taxpayer is really bringing in. For example, myself and my spouse, we have contributed a lot of money to retirement over the years. And I feel like adjusted gross income, because we're both contributing as much as we can, that is reducing our adjusted gross income. So it doesn't feel really fair to me to compare us to, say, our neighbors across the street who are not contributing to retirement. I'm not saying our neighbors across the street are not contributing. I'm just saying, as an example, someone who is not doing that specified activity that reduces adjusted gross income. Once we get to AGI, then we subtract either a standard deduction or an itemized deduction. And in recent years, the standard deduction has become much larger. So most taxpayers today will use the standard deduction. That's just a number that the IRS comes up with that says, this is the gimme. We're just going to knock off, $20,000 and you don't have to track any of your receipts. We're just going to knock that amount off of your income before we get to taxable income. And then there are itemized deductions. If someone, for example, has a lot of charitable contributions are in that bucket. So let's say hypothetically that an individual has contributed $25,000 to charity. If the standard deduction is $20,000 and their itemized deduction total, let's say all of the total is made up of the charitable contributions, then they're going to get to take the $25,000. So you get the greater of itemized deductions or the standard deduction. And as I mentioned, most taxpayers today, because of the change in the tax law recently, where the standard deduction has gone up quite a bit, most taxpayers today are using the standard deduction. If we go back 6 or 7 years or 10 years or 15 years, there were many more taxpayers who took the itemized deduction because things like mortgage interest, charitable contributions, and state taxes that were not limited at the time were included in that itemized total. So we subtract, let's say, the standard deduction, and then we get to taxable income. Then the tax is applied, and then whatever the total tax is, we're then going to subtract any estimated payments and withholding that has been done to get to what's due with filing. And I think there can be some confusion about how much tax someone pays based on how much they owe with filing. The amount of tax that someone has to pay is the total tax on the tax return. Whereas the amount that you have to pay with filing, that could be just a portion of the total tax. So sometimes I think because taxpayers have to write the check when the tax return is filed, that they're thinking, this is the amount of tax that I pay. And when they hear that their neighbor across the street got a refund, it feels like the individual has to write a check, pays more in tax. But it's really just a function, in most cases, it's a function of the person who got the refund, they had more withholding taken during the year or made estimated payments during the year. So those are the high level elements of a tax return. And now we're going to look specifically at the form. I've listed a lot of line items on the left side, just so you know the detailed components. And as I mentioned, there's a reason that each of these are broken out. But the important thing to know is that we're just reporting totals in here based on how they come on the form. So the form W-2 is the what your box one earnings are going to end up in that line 1A. I realize as I'm saying this that I inadvertently drop into terminology that we use when we're looking at the form. So hopefully I haven't gone overboard in that minutia, because I really want this to be something that becomes understandable to you, again, whether or not you decide to tackle your tax return or whether you have a preparer do your return. I think it's important to know where these numbers are going. It is not some magic box. You should get the same result whether you do the return or a professional preparer does the return. There are some, when you have a business, there are some choices and differences that should come up, but it reminds me of a story. There was a friend of mine who had he was using TurboTax to prepare his own tax return for years. And then he decided to hire a tax preparer to do his return. And what he did in the first year is he prepared it on TurboTax and also had the preparer prepare the return. And he said to me, I don't know why I was paying her, because we got the same result. And to me, it was great insight, because I didn't realize at the time that some taxpayers expect there to be a different result if they're using a professional. And specifically, they might think that the professional is going to make the result so much lower in tax that it's going to pay for the preparer's fee. And the reality is that is not the case. You should get the same exact result, whether you prepare it or whether you have 5 different tax preparers prepare the same return. That's important to communicate. So here are the different components we see in that top box. We've got our different categories of income, and we arrive at that line 15 that is, I'm sorry, I've really cut this one down here. So this is the same thing as the P&L. So you can see we go 1A, 2B, 3B, and then it goes to 8. So there are lines in between there that I've just cut out to make it easier to see. Mm-hmm. But we get to total income on line 9. Then we have adjustments, that one line 10, because it references another schedule. And then we have the standard deduction, line 12. And then we finally arrive at taxable income on line 15. That amount is then going to be applied to the tax rates. Then you're going to have maybe some additional taxes like self-employment tax for business owners. And you're going to finally get to total tax there on line 24. And then you're going to consider estimated payments you've made, withholding, to determine the amount that you owe with filing. So one other thing I wanted to mention about the tax rates. Another misconception that can occur is if I make $150,000, then I'm going to pay, the taxpayer might think I'm going to pay 20% federal tax. And if I make $200,000, I'm going to pay 30% federal tax. And there's this idea out there that if you earn over a given dollar amount, that all of your income is taxed at a higher rate. That is not the case. So tax rates in the United States are graduated. So the first dollars that you earn are taxed at either not taxed at all or taxed at a very low rate. And then as you earn more income, the incremental dollars that make up the higher income, those are taxed at a higher rate. But overall, you end up with a blended rate. So you never have to worry. You're always better off making more income. And I use the figures that are relevant here. I'm in the Bay Area in California. And yes, everything you've heard about cost of living is true. It's very expensive to live here. So the income that is required really is a pretty high number. The good news is, at least in my experience, many people who live here in the Bay Area, we also have great jobs that are out there. So, but it's still not easy. Cost of living is a big component of, I mean, cost of housing is really a big component of the total cost of living. So so we've seen the tax form that's reporting total income. What we did not see is the schedule that is specific to uh, to the business earnings. So we're going to go through that specifically because you're a business owner, and we didn't really cover I saw my business P&L earlier, where does that end up on the tax return? So most of the businesses in the United States are sole proprietors, and I am a sole proprietor, sole prop, as we say in the biz, and we're using Schedule C to report our business income and expenses. Why is it named Schedule C? I have no idea. This is the IRS's infinite wisdom about coming up with schedule names and form names. So I looked up out of curiosity how many Schedule Cs there are in the United States, and there are about 23 million sole proprietor businesses in the US currently that are using Schedule C. That number is so large that if you take all of the C corporations and partnerships and S corporations and LLCs and you combine them, the number of Schedule Cs is still 2.5 times all of those other types of returns combined. So it's really common. And that's why we're going to use that as the example for how businesses report. I want to call out one other fallacy while we're on the topic. Some taxpayers feel, or business owners feel, that if they incorporate or become an LLC, that they're going to be eligible to take more deductions or have special parameters where they're able to write things off that sole proprietors are not. This is a myth. This is not true. So, I mean, there's one small exception for C corporations with medical expenses, but basically, your basis for tax, income less expenses, and the types of expenses that you're able to deduct are absolutely positively the same, whether you are an S corporation, an LLC, or a sole proprietor. I think the reason that this misconception occurs is because I'll say it, there are accountants and attorneys who are recommending incorporation not because it is of a specific benefit to the small business owner, but because it creates more legal work and more accounting work for the industry. So being incorporated does have some benefits, and it does have a legal, it does play a role legally, but tax wise, if we're strictly looking at income tax, it's synonymous whether you're incorporated or a sole proprietor. There is another kind of concept within the S corporation world where you have the ability to somewhat change the wage amount for officers. So there is some discretion, but I don't want a taxpayer to get the impression that simply by incorporating, they're going to open up some box of deductions that didn't exist as a sole proprietor. That's the myth I want to bust here. So here is the tax form that's used for an unincorporated business, a sole proprietor. This is the Schedule C. It's got a lot of words on it, a lot of boxes on it, but we're basically reporting our total revenue, money in from customers, and our total money out. So what's shown on the upper left here is the front page of the Schedule C, and what's shown on the right is the second page. And the second page has a detail for cost of goods sold because for a inventory concern, you would start with your beginning inventory, you would add purchases, you would subtract what you sold to get to your ending inventory. So it's just a way to calculate it if you don't have QuickBooks or some other form of accounting software that comes up with that number. So I want to focus on demystifying this even more specifically by showing the total money in, the total revenue part of that Schedule C. So as you can see here, it's a little bit blurry because I blew it up so much, but line 1 is gross receipts, total money in. For many businesses, that's the only line that will contain anything on the Schedule C. There are some businesses that track returns where you would have activity on line 2. Cost of goods sold, if you're a retail concern, then you're going to have cost of goods sold on line 4. And then notice that even on the tax return, just like on the P&L, they get to a calculation for gross profit. So that's what we see on line 5. There's some other income, maybe interest and dividend income that the business has, and then you get to total income. So that's the money inside of the Schedule C. On the money outside of the Schedule C, there are a number of categories that the IRS has created here. I want to emphasize that how your expenses are categorized is up to you. There is no global list that says if you paid, Google for advertising, that it must go on line 8. Some business might consider Google advertising to be an office expense. It's your choice. And I use that example specifically because I think you might be thinking, well, if I'm paying Google for advertising, it has to go on the advertising line. But the whole point is there's no rules on why it needs to be categorized on a given line here. So the reason that all of these categories exist is because the IRS is trying to make it easier on business owners to be able to think about what types of expenses their business has incurred. That's really why all of these categories exist. You could, just to show an extreme example, a business could show total revenue, $100,000. Total expenses, $30,000. They could all appear on line 18 office expense. and that would be perfectly acceptable. I personally wouldn't do that and just have all expenses on one line. And the reason I wouldn't is that the IRS does expect expenses to be spread over a number of lines, and they're going to consider that unusual if all the expenses are in one category. But just to prove the point, technically, that's okay. And by that I mean if the IRS finds that unusual and they decide to ask why is everything in office expense, the taxpayer would be able to defend that and say, well, I decided it was all related to office. Here's the receipts, and here are all the bank transactions, which we'll talk about in a second. And I decided that they should all go on office expense. I don't like complexity. That's perfectly okay. It is your decision how you categorize expenses on your tax return. So that's another thing I think that's important to call out, especially if you have a tax preparer preparing your return. Almost 90% of business owners will have a professional prepare their return. So in that scenario, there can be a lot of questions about, well, I gave you a P&L, and now it all seems like it's in categories. I don't know where you got the total for office expense. Why is it categorized that way? It's really just the discretion of whoever happens to be preparing that return. And for that, well, we'll talk about how you can help yourself and help the tax preparer as we go forward. So these expenses on the tax return broken out in more detail, I just wanted to highlight some of the common ones. So there is a line 12 for depletion. I'm in California, so that may be part of the reason, but I have never in my entire almost 30 years or so of preparing tax returns, I have never seen an amount on line 12 for depletion. So the common ones we see are advertising, commissions, contract labor, insurance, legal and professional services, anything you pay a third party to do, office expense, rent, repairs, supplies, travel. These are the common ones. So when you really get down to it, there may be 10 or fewer categories that you're going to report on your business schedule. And remember, it's up to you how you claim it. Well, I mean, it's not entirely up to you. As I said earlier, I should qualify that with meals expense, if you put it in your mouth, it's meals expense. And that is currently only 50% deductible. It's a strange thing to mention because a few years ago, because of all the changes in the world, the IRS decided to make meals 100% deductible, which is the first time since I think the early 1980s. But for purposes of discussion, meals are only 50% deductible. So meals are something where you want to categorize that appropriately. It wouldn't be okay to put that in office expense. So that's a little highlight on meals. So now I want you to see how what we looked at earlier on the profit and loss report, how it gets to the Schedule C. And this is just talking about total revenue. So here we have the total income. Oh, and here we see the subtotal for landscaping services. So again, I've cut this report up. I don't know that the total is really gonna add up. This is just to highlight that when you see total income on the P&L, that's gonna go to gross receipts on the Schedule C. If you have direct cost of goods sold or cost of sales, you can put that on line 4. For a service business, by the way, even though a service business has direct costs, you may for your books purposes, show the cost of sales as a specific component because you want to identify what your gross profit is. You want to know for every $10 of revenue that I have coming in, I don't want to spend more than $6 in direct costs. That's a valuable thing for a business owner to know. When it comes to tax reporting for a service business, even though you might break out that cost of sales on your P&L, you can put that in legal and professional services or office expense. You can put it in the overhead expenses category. You don't need to put it here in cost of goods sold. And the reason I mention that is it might be confusing for the IRS to see a service business that has cost of goods sold. Not impossible, perfectly common for service businesses to also sell products. But if you have a really large cost of goods, what's shown here is cost of goods sold, you might want to put the services part of it just in other expenses. So that's the revenue side. When we switch gears to the expenses side, here we have parts of the P&L on the left side and the Schedule C expenses on the right side. So we can take that advertising and just put it directly over. The automobile expenses will eventually end up on line 9, but with automobile, there's a separate worksheet where you're going to have your business miles times the standard mileage rate, or your business percentage based on business miles over total miles times the actual expenses. So there's some separate detail. It's not like the number goes directly onto line 9. And that's another thing to call out. If you're using a professional preparer and you have your automobile expenses, and you see here it's $463, and then you don't see $463 on line 9 of the Schedule C, the reason that differs isn't because it's wrong. It's because the tax preparer has considered whether the standard mileage rate results in a greater deduction for you. So that's a reason where the P&L can differ from the Schedule C and be correct. But with most expenses, you're going to see some grouping that goes on between the P&L and the Schedule C. So another category to call out, we've got legal and professional fees. That would go directly onto line 17, which is legal and professional. So here are some tips for how you can improve your books that will help you and your tax preparer. So the most important thing, I feel like, if you only remember one thing from the time we've spent together today, it is to simplify and have as few categories as possible on your P&L. So you should really only have an income or expense category on your P&L if it's valuable to you. So one example I'll use is telephone expense. Almost every business owner, A, has telephone expense, and B, has a category for telephone expense. And telephone is something that we're not likely to look at the amount of telephone expense, and if it's large, say, oh, well, I've just got to stop using the telephone. I'm going to eliminate that expense. That is unlikely. So the question is, why is it its own category? And I would argue that it's better, if you're going to have it be its own category, that's fine, but make it a sub-account of office expense. Because having it on its own separate line adds more complexity to the P&L and is of no value to you. You're not going to make a business decision based on what telephone expense is. So if you're not going to change something in your business based on what the amount of a line item is, then keep it simple. And you might want to consider a starting point for your expense categories as the Schedule C itself. Most businesses are performing accounting basically in service to the tax return. That's the reason that they have books in the first place. So because of that, it's going to make it easier if you're preparing your return, and it's going to make it easier for your tax preparer if you're using the Schedule C categories as your expense categories. So that's a great start point. And you might think, well, why would I want to make things easy for my tax preparer? That's what I'm paying them for. That's fair, but it's also going to make it easier for you because the P&L that you send your tax preparer, you know, has the categories that are on the Schedule C. So you can very quickly check and make sure that no mistakes were made and that you're getting the appropriate amounts on your Schedule C. And then one final note on books is that it's really common for business owners to use vendor names as expense categories. And I know that if you're uncomfortable with categories and you think before you heard what we've been talking about today, and you think, oh, well, I don't want to screw anything up, so I'll make a category for each very specific thing, you might end up with a P&L that shows USPS expense, a separate category for UPS expense, separate category for shipping, or you'll see a category for AT&T, things of that nature. So you in QuickBooks, for example, you're going to have separate reporting. You're going to be able to look at expenses by vendor. So you don't need to basically, you don't need to have an expense category that links directly to a vendor. So simplicity is really what you want in your books, both because when you look at a P&L, you want to be able to analyze that quickly, and it's going to make it easier when it comes time to prepare your tax return. As far as the tax return goes, I feel like simpler is better, even on the tax return. One of the things that I didn't really highlight when we looked at the Schedule C, but there is I believe it's line 27 on the Schedule C that has other expenses. And you can come up with as many categories as you want and put in any amounts. So you could have a bunch of extra category names and show them on your tax return. There's nothing wrong with that, but I feel like it's unnecessarily complex. Why not put it in office expense? What does it matter? As long as you have a link that where you know this number this number on the tax return is made up of these 7 categories on my P&L. I know where those transactions are. I know how that amount came to be. That's all you need. You don't need to create a bunch of additional categories that are not already on the Schedule C. The important thing is that you can trace the amount that's on your tax return back to individual transactions. That's what's really important. So if you're using a professional tax preparer, they should have documentation on this is where I got this number. I took these 5 categories on the P&L. I put them all in office expense on the Schedule C. If you're preparing your tax return, you would want to have the same documentation, because if the IRS has any questions, they're going to ask, so what are the transactions that make up office expense? And you're going to be obligated to show the IRS, here are all of the transactions. You may point out that you've got them in separate categories on your P&L, and that's, you combine them for simplicity, but having the link between the two and being able to trace that from the tax return back to your books is critical. A final note about having the right information to be able to defend your tax return is that you need to have both the evidence of what the business purpose was for a given expense and the bank statement or credit card statement showing the movement of money. Many business owners, for whatever reason, think that a bank statement or a credit card statement is sufficient to defend expenses if asked by the IRS. And this is not true. You absolutely positively need to have the original receipt that shows the detail. I got paper from Staples so that the IRS can determine whether that was an ordinary and necessary expense. And then you also need to have evidence of, this was a credit card charge. Here it is on the credit card statement. And then a month later, I paid the credit card. So evidence that the money moved. So having original receipts is always important. QuickBooks Online makes it easy. You can actually attach a receipt directly to each transaction. And any other accounting app would have a similar tool where you can link an expense to a receipt or other source document. It might, your support for automotive expense could be a mileage log times the mileage rate. It doesn't always need to be a receipt in the traditional way we think about something that comes out of a cash register, but most of the time that's what it is. So that's why I use that terminology. So just another reminder that you have resources at the SBDC. So use those resources. And of course, the North Central Texas SBDC has incredible learning like today's session. Hopefully you found it valuable, and other similar sessions that are of value to you, as well as many other resources. So if you're in the area, use the North Central Texas SBDC. Otherwise, you can find your local SBDC. And I will address any questions that have arisen, if they have.
If you have any questions, please feel free to unmute yourself and just ask Bryce. I have a couple of questions.
Yeah.
When you were talking about, make more money, pay more taxes, is that what they mean by tax brackets?
Yes, that's exactly right.
Okay.
There are graduated rates. The federal rates start about 10% and end, I think, currently at 39.6. And so so the more money you make, the higher dollars will start to fall into those higher brackets.
Okay.
But yeah, tax bracket. Yeah, and we talk about there's a marginal tax rate, and that means the highest rate that you're paying, but you're only paying that rate on those last dollars that were earned. And then there's what's known as your blended tax rate or your overall tax rate or your effective tax rate. And that means take the total tax you paid and divide it by your total income, or in many cases, divide it by your adjusted gross income. And that's going to be your effective tax rate. So for somebody making, let's say, $300,000, a family making $300,000, their marginal tax rate could be, marginal federal tax rate. Don't quote me on this. I'm just making it up for example. Could be 25%. But their effective tax rate could be 18% because the lower dollars were taxed at the lower rates. The long answer to that question, but does that make sense?
Yeah, it does. It really does, which surprises me that it actually went in and I understood what you said. I don't math well. I really don't math well. Uh,
That's funny.
uh, and you were talking about, for example, the office expenses. And
Yeah.
if you wanted to like detail which office expense, so if maybe you think your employees are using too many Post-it notes,
Hmm.
and so now you want to break it out to track how many Post-it notes. That's really just something for you, right? And
Exactly.
it would all still roll up into office expenses.
Exactly right.
Okay.
So if I
Gotcha.
didn't mention it as I was discussing it, if you want to add a category for any reason or no reason, that of course is your prerogative. My input would be to make it a sub account.
Uh-huh.
So you can have office expenses and then maybe 10 sub accounts where you, for your own whatever reason you feel better about categorizing telephone expense, you can have a sub account of office expense called telephone expense.
Mm-hmm.
So that, and any other category that goes in there, other than meals, meals would be separate. But on the tax return, it would just be the total of office expenses.
Mm-hmm.
But when you look at your P&L, you can have a number of subcategories under office expense that are helpful for you to maybe you just want to know, how much of total office expense is spent on office supplies as
Mm-hmm.
separate from I don't know, the items that go into what am I or like software and subscriptions. That's also office expense, but maybe you want to keep it separate from the physical office supplies. Those can be subcategories.
Gotcha. Okay. So just for your own benefit, just to track and be aware of what's going on. But
Exactly right.
it's not necessary for tax purposes.
Right.
Okay. Gotcha. Gotcha.
And it may also just be easier to record transactions if you have those really detailed categories,
Mm-hmm.
especially if someone in the office is doing the bookkeeping. It may be helpful for that individual to have subcategories. He or she may not realize that it's all office expense. Um, so having subcategories can be helpful.
Okay.
And
Cool.
most businesses will have some form of assistance with the bookkeeping, whether they're outsourcing all of the bookkeeping to a professional or having a bookkeeper check in with the books every month or 5 or 6 times a year. Most businesses will have that because I feel like it's important to call out that even though QuickBooks, for example, makes it relatively easy to do the books, there can be some anomalies that happen because the software can be kind of tricky and just the overall goal of getting all of your income and expenses categorized can be more complex than it seems. And
Mm-hmm.
so I think it's important to have a bookkeeper at least check in, if not do the regular role of reconciling, comparing what happened in the books to what happened on the bank statement to make sure that you've got the right amount of income. Because if you're misreporting, even if it's an accident and the IRS has questions, then the taxpayer's on the hook for that. So it's an extra layer of insurance, if nothing else,
Okay.
to have a professional bookkeeper.
Thank you.
Yeah.
Um, are there any other questions?
Yeah, one point I wanted to bring up is the accrual basis on QuickBooks as a default. So
Mhm.
if you have a services business and you have accounts receivable, by the end of the year, there has to be something that has to be done to move that and then create a frozen snapshot. Can you talk on that a little bit for the benefit of business owners.
So the choice to report for tax reporting on accrual or cash is just a choice that the business owner makes. And after year 2, there's almost no difference between the two. But if the tax reporting method is cash basis, there are 2 ways to handle it. You can run the reports on accrual, and then for any accounts receivable or accounts payable, for using accounts receivable, for example, if you have an accrual profit and loss statement and accounts receivable is $10,000, then you would make an entry or an adjustment, really probably an adjustment just for tax purposes, where you say, I'm going to reduce income by $10,000 on this accrual profit and loss statement to make sure that I'm reporting for tax purposes on a cash basis. The other alternative is to run the report in QuickBooks as a cash basis P&L. And then the accounting application, QuickBooks, will adjust the total amount of revenue to reflect the total of payments that have been received as opposed to invoices created. And I mentioned the 2 ways because some tax preparers don't trust the QuickBooks cash basis reporting. And they have reason not to trust it in some cases if the transactions don't follow the traditional flow. So for example, if you get a payment in advance of when the invoice date is, that can get a little bit wonky. So you can always run an accrual basis P&L and then adjust out for accounts receivable and accounts payable. Those are the only transactions that have a difference between cash and accrual in QuickBooks.
Thank you.
Oh, any last questions? Well, Bryce, this has helped me understand my tax preparer a little more. And honestly, I want to make it as easy for her as I possibly can. So
Fantastic.
I definitely don't want her to have to work harder.
Yeah, and the other benefit is, at least for me as a tax preparer, if the numbers are really easy to get into the return, then I can spend more time on that tax return, on analytics or looking over other elements. Whereas if I'm tied up doing, just getting the numbers and to iron out, then I have less time to think at a broader level with that client about the tax return. So I think efficiency is always better.
Well, Bryce, thank you so much. As
Thank you.
usual, this was absolutely wonderful to hear, and it's one that I'm going to have to watch a couple of times because of the subject matter. But very worthwhile information. Thanks so much. Looking forward to the rest of your series
Yeah,
too.
thank you.
I've just put up our upcoming webinars, and just want to share that next week is a busy, busy week. We have quite a few webinars coming up, like Bryce will be back. And if anybody wants to register for those webinars, you can use that QR code up in the upper right-hand corner. It will take you to our SBDC website, North Central Texas SBDC website. That's where you can register. You can get our contact information, schedule an appointment with an advisor, or find some of the resources that we already have listed on our website for small business owners. And I want to thank everyone for joining us, but I really want to recognize our benefactors, those that keep us in business. We receive funding from the Small Business Administration, the state of Texas, North Texas SBDC Regional Office, and our host institution, North Central Texas College. I want to thank you for all of all of the support that we get from these organizations. Thank you for joining us today, and we look forward to seeing you on Tuesday. And everyone have a wonderful Labor Day holiday. And this will end the webinar. Thank you all for joining.